aware of the new income tax rules for provident funds? For instance, what is the income tax liability of a PF account? How will the government calculate your tax on the taxable portion of your PF interest? Well, if you want to know all of these in very simple terms, then watch this video till its end. Hello and welcome everyone. This is Jyoti Arora. I'm a tax expert. As you all know, Clear is India's largest tax filing platform where we have served more than 6 million users to file their taxes. So please remember to like and share this video and also hit the subscribe button to stay tuned with us. Now let's get started. If you are an employee, then you know that your company deducts PF from your salary. This is because any company that has 20 or more employees in total is required to deduct EPF from the employees who are earning a minimum salary of rupees 15,000. So as you know that most of the employers deduct PF from the employee's salary. Now let's see what was old and what is new PF tax rule. Before the budget 2021, the entire amount earned as interest from PF accounts stood as tax-free. So the old rule was quite simple, that any amount of interest earned from your savings in PF account would be tax exempt. However, the government observed that high income earners used to deposit crores of money into their PF account and would make their high income tax free. In order to tax these high income earners, the government brought an amendment to this rule. In Budget 2021, a major change in the history of PF taxation was brought, wherein any interest earned on the contribution above a threshold would now be taxable. Now, the threshold limit for the non-taxable provident fund contribution for employees where the employer does not contribute is rupees 5 lakhs, whereas in other cases, the threshold limit is rupees 2.5 lakhs. Hence, in case of general provident fund, which is only for government employees, the limit is rupees 5 lakhs. Now let's see what are the points that should be remembered related to PF taxation that were highlighted in Budget 2021. The interest income earned on the excess contribution will be taxable only in those cases where the employee's annual PF contribution exceeds rupees 2.5 lakh or rupees 5 lakh, as the case may be, that we have just discussed. Next, the interest taxability shall be applicable for the contributions made on or after 1st of April 2021. That is in retrospective nature. So here also note that it is the interest on the excess contribution which is taxable and not the contribution in itself. Many people have this confusion. The excess contribution cannot be taxed as the contribution is made by the employee from his salary, which is already subject to tax, right? And last point to be clarified here is that the contribution to PPF is already restricted to rupees 1.5 lakh, and so this amendment will not have any impact on that restriction. It still continues. Now let's understand the calculation of tax on excess PF contribution. The Income Tax Act has inserted a new Rule 9D which specifies the method with which tax will be calculated. The Provident Fund Office or the Employee PF Trust will maintain two accounts for this purpose: taxable contribution account and non-taxable contribution account, along with the interest earned in these accounts. Now, one account with contributions within the threshold and the other account will have contributions over the threshold. As far as the balance standing to the credit of the employee as on 31st of March 2021 is concerned, interest on this balance will be accumulated in the non-taxable account and will continue to remain tax-free. It is the interest on the second account, that is the taxable contribution account, which will be taxed every year. The taxability for this taxable account is not only for the year of contribution but also for all the subsequent years in which the interest income will be earned. So now let's see how you will calculate the amount in the non-taxable contribution account. So the amount will be total of the following, which is first closing balance in the account as on 31st day of March 2021. That is the opening balance as on 1st of April 2021. Second is any contribution made by the person in the account during the previous year 2021, 2022 and subsequent years up to the threshold limit of the non-taxable contribution, which is either 2.5 lakh or 5 lakh as the case may be. And third is the interest accrued on both of these amounts, that is on the opening balance and on the amount which is within the threshold every year. So in order to calculate the non-taxable provident fund contribution, you aggregate the first amount, that is the balance, opening balance, and the second amount, that is the amount which is within the threshold every year. Third, you reduce that amount by any withdrawals from such account. Now let's see how taxable contribution will be calculated. So taxable contribution amount will be total of two amounts again. First is any contribution made by the employee or the person in the account for each financial year above the threshold limit starting from financial year 2021-22. Now the threshold limit is rupees 2.5 lakh or 5 lakh as we just discussed. And the second will be interest accrued on the contribution made more than the threshold limit. So how will you calculate it? First, aggregate of the first amount, which is the contribution above the threshold, and the interest accrued on it, reduced by the withdrawal from such account. Now suppose Mr. Amit deposits a similar amount in financial year 22-23 also. So the interest earned on the non-taxable account will still be exempt, and the interest earned in the taxable contribution account will again be taxable. Here we have assumed that Amit deposits the amount in the first month of financial year, and so we have considered full year's interest. In case the investment is in middle of the year, the interest component will be on pro rata basis. Now let us understand this example using an illustration. For instance, Mr. Amit has a PF balance of rupees 5.5 lakh, which is inclusive of interest as on 31st of March 2021. He works with a private company and has contributed 3.5 lakh into his PF account in financial year 21-22. Assuming an interest rate of 8%, let's see how we will calculate the interest on both of these accounts. So first we will separate the contribution into taxable as well as non-taxable contribution. So rupees 2.5 lakh will get deposited in a non-taxable contribution and rupees 1 lakh in taxable contribution account. Interest on rupees 8 lakhs in non-taxable contribution account works at rupees 64,000. Now 8 lakhs is the opening balance plus the contribution made. Now this interest of rupees 64,000 will be exempt, whereas the interest of rupees 8,000 on 1 lakh will be taxed according to the income tax slab of the individual. Now suppose Mr. Amit deposits a similar amount in the next year, that is financial year 22-23 also. This was all about how your interest will become taxable if you contribute more than the threshold limit in your PF account. Hope you now understand this. If yes, then please type clear in the comment section below. So as you see, for all the subsequent years, interest amount will also get added back to the principal. That is, it will get accumulated in the taxable contribution account, and any earnings on this accumulated balance will become taxable according to this new rule. The EPFO earlier this month decided to lower the interest rate to a 4-decade low of 8.1% for 2021-2022. Now, the decision to cut down the interest to 40-year low was taken after much resistance from the trade unions at the EPFO's board meeting. Even with the lowered interest rate, PF is still one of the best tax-saving investments, which also helps you to save for your retirement. So make sure that you plan your taxes from the start, and you start saving and investing from the beginning of the financial year itself. Thank you for watching this video, and please do hit a like button if you found this video useful, and subscribe to our channel to stay tuned for more such informative videos. Take care. Bye bye.